Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Roles and Functions of Central Banks. Central banks play a pivotal role in shaping the monetary policy and economic stability of a nation. As institutions at the heart of a country's financial system, central banks are charged with a multitude of responsibilities, ranging from regulating the money supply to ensuring the stability of the financial system. This lesson delves into the roles and functions of central banks, providing an in-depth exploration of their contributions to economic stability and growth. The primary function of central banks is to control the money supply and interest rates in an economy. Through monetary policy tools such as open market operations, reserve requirements, and discount rates, central banks influence the amount of money circulating within the economy. By purchasing or selling government securities in open market operations, central banks can increase or decrease the money supply. For instance, when a central bank buys securities, it injects money into the banking system, thereby increasing the money supply and lowering interest rates. Conversely, selling securities withdraws money from the system, reducing the money supply and potentially raising interest rates. Interest rate manipulation is another crucial tool used by central banks to influence economic activity. By adjusting the discount rate, which is the interest rate at which commercial banks can borrow from the central banks can control the cost of borrowing. Lowering the discount rate makes borrowing cheaper, encouraging spending and investment, which can stimulate economic growth. On the other hand, raising the discount rate discourages borrowing, which can cool off an overheated economy and help control inflation. Central banks also play a critical role in maintaining financial stability. They act as lenders of last resort to commercial banks during times of financial distress. This function is vital in preventing bank runs and ensuring liquidity within the financial system. For example, during the 2008 financial crisis, central banks across the globe, including the Federal Reserve in the United States, provided emergency liquidity to financial institutions to stabilize the financial system and prevent a complete economic collapse. Another significant function of central banks is the regulation and supervision of the banking sector. By establishing and enforcing regulations, central banks ensure the soundness and safety of the financial system. They conduct regular inspections and stress tests on financial institutions to assess their resilience to economic shocks. This regulatory oversight prevents excessive risk-taking and promotes confidence in the banking system. Moreover, central banks are responsible for the issuance and management of a country's currency. They determine the quantity of money in circulation and ensure that the currency remains stable and trusted by the public. This function extends to the management of foreign exchange reserves, which helps to stabilize the national currency and protect it from speculative attacks. Central banks also play an essential role in formulating and implementing monetary policy to achieve macroeconomic objectives, such as controlling inflation, reducing unemployment, and promoting economic growth. Through a combination of monetary policy tools, central banks aim to maintain price stability, which is crucial for economic planning and investment. For instance, the European Central Bank targets an inflation rate of below, but close to, 2% over the medium term to ensure price stability within the Eurozone. In addition to domestic responsibilities, central banks are involved in international monetary cooperation. They collaborate with other central banks and international financial institutions, such as the International Monetary Fund, to address global economic challenges and promote financial stability. This cooperation is essential in a globalized world where economic events in one country can have far-reaching effects on others. A practical example of the central bank's role in economic stability can be seen in the actions of the Federal Reserve during the COVID-19 pandemic. In response to the economic downturn caused by the pandemic, the Federal Reserve implemented a range of monetary policy measures, including cutting interest rates to near zero, purchasing large quantities of government securities, and providing emergency lending facilities to support businesses and households. These actions were aimed at stabilizing financial markets, supporting economic activity, and mitigating the impact of the pandemic on the economy. Furthermore, central banks engage in economic research and provide valuable data and analysis to guide policymaking. They produce reports on economic conditions, financial stability, and monetary policy, which inform government decisions and public understanding. This research function enhances the transparency and accountability of central banks, fostering trust and credibility in their actions. Central banks must also navigate the challenges posed by evolving financial technologies and innovations. For example, the rise of cryptocurrencies and digital currencies presents both opportunities and risks for central banks. While digital currencies can enhance payment systems and financial inclusion, they also pose regulatory and security challenges. Central banks must adapt to these changes by exploring the potential of central bank digital currencies and developing appropriate regulatory frameworks to address the risks associated with digital assets. In conclusion, central banks are integral to the functioning of modern economies. Through their roles in controlling the money supply, regulating interest rates, maintaining financial stability, supervising the banking sector, issuing currency, formulating monetary policy, and engaging in international cooperation, central banks shape economic outcomes and contribute to overall economic stability and growth. The actions of central banks, whether during times of crisis or in the pursuit of long-term economic goals, underscore their importance in the global financial system. As financial technologies continue to evolve, central banks must remain vigilant and adaptive to ensure they can effectively fulfill their roles and meet the challenges of the future. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.